The investment environment has been volatile, asset class returns have been soft as the global fight against inflation has intensified. We believe that global markets are now transitioning into a 3G environment of a great decoupling, a great volatility, and a great reset. The great decoupling reflects differing inflation pressures, geopolitical dynamics, and policy responses across countries. For example, Asia is containing inflation generally better than developed markets, and as a result, it has more policy options to support growth into next year. In contrast, the UK and Europe have much higher inflationary stresses, which is resulting in significant falls in their currencies and surges in yields. Geopolitical dynamics are driving some pushback against globalization with increased reshoring of manufacturing and supply chains. The great volatility is adversely impacting investment returns and reflects increased geopolitical risks, high inflation, and tighter monetary conditions. Lastly, the Great Reset refers to the rise in real bond yields, especially in the US, in part because inflation uncertainties are driving a higher term premium. This implies a higher cost of capital going forward and some downward pressures on equity valuations. Encouragingly, a lot of bad news, especially in the US, has been priced in by markets already, and therefore the bottoming process can continue. But nevertheless, reflecting the 3G forces that we have highlighted, we do remain defensive on global risk assets. Investors should be prepared for further downside risks to earnings given the significant rise in yields. Europe remains our least favoured region as its adverse stagflationary forces are acute, and as a result a painful recession may unfold. In Asia, investors are looking for clarity on when China's recovery will gain momentum. Despite a soft macro backdrop, there are still opportunities. Investors have been able to find alpha with defensive growth stocks outperforming cyclicals, especially across developed markets. In Asia, China's value stocks have outperformed growth stocks. These trends can continue until there is more clarity on how strong global growth will be next year. In navigating challenging markets, sector selection has become even more critical. We are positive on industries with well-established drivers like technology, e-commerce, consumer products, healthcare, and renewables. Some encouraging indicators suggest potentially improved investment performance going into next year, with more evidence that US inflation is peaking and that the Fed has established a more credible path for monetary conditions to tackle inflation. Of course, the prospect of weaker growth cannot be totally ruled out, but what remains encouraging is that most investors believe that the US can avoid a deep recession as its labour market is holding up. For China, the consensus expects a significant rebound in growth next year, and there are also signs that the debt deleveraging process in the property sector may be bottoming. However, China's policymakers still have to balance their COVID control policies with growth and to try and stimulate stronger credit demand from households.